Your grandmother buried savings in the backyard. Not because she was uneducated, because the bank failed, the currency collapsed, the government froze the accounts. And the only money the family kept was the money nobody could find. That was the right move. In that country. At that time. Now you are in Canada. And you are still running a version of that same strategy. Not in a backyard. Maybe in a home country bank account nobody here knows about. Maybe in a Paluwagan with 12 people from your church. Maybe in gold jewelry your family insists you never sell. Maybe in a stack of cash in a drawer because you still do not fully trust the institutions here. I'm not going to tell you that you are wrong. I'm going to show you exactly what those habits cost in a country where the institutions actually work. Here is the number that frames everything in this video. According to Statistics Canada's Survey of Financial Security, immigrant households in Canada participate in registered accounts, the TFSA, the RRSP, at significantly lower rates than Canadian-born households at identical income levels. The gap is widest in households that have been in Canada fewer than 15 years. That means a person earning $80,000 a year, 10 years into their Canadian life, is building wealth more slowly than a Canadian-born person earning the same salary. Not because of income, not because of intelligence, because of which accounts they are using and which ones they are leaving empty. The TFSA annual contribution limit in 2024 is $7,000. If you arrived in Canada in 2015 and have never contributed, your accumulated room right now is somewhere between $50,000 and $60,000. That is $50,000 to $60,000 of investment growth Canada has offered to shelter from tax permanently on your behalf. Every year that room sits empty, while your money sits in a home country bank account, or a group savings circle, or a jewelry box, is a year of compounding the Canadian tax system cannot recover for you. That is not a judgment. That is arithmetic. I want to give you 3 specific pieces of evidence. Each one names a habit. Each one prices it. The first is the cash habit. A standard savings account at a major Canadian bank currently pays between 0.5% and 2% annual interest depending on the product. A basic index ETF held inside a TFSA has returned an average of approximately 7% annually over the last 20 years in Canadian dollar terms. On $20,000 held in cash, our low-interest account, rather than a TFSA sheltered index position, the 20-year difference is approximately $57,000. Tax-free. Gone. Because of which container the money sat in. The second is the group lending circle. The World Bank's remittance prices database tracks the cost of moving money internationally from Canada. Depending on the provider and the destination country, sending remittances from Canada typically costs between 3% and 6% of the transaction value. On a household sending $10,000 home per year, that is $300 to $600 in transfer fees annually before the money even arrives. That fee cost is recoverable. There are low-cost digital transfer providers regulated in Canada that charge a fraction of what the major banks charge. The question is not whether to send money home. The question is how much you are losing in transfer costs that a 15-minute account setup could eliminate. The third is the foreign account interest and the Canadian tax obligation most people in my audience do not know exists. Canada Revenue Agency requires you to report foreign income, including interest earned in bank accounts outside Canada, on your Canadian tax return. If the total cost of your specified foreign property exceeds 100,000 Canadian dollars, you are required to file a T-1135 form. Non-compliance carries significant penalties. I'm not saying this to frighten you. I'm saying it because every person in my audience who has been quietly parking money in a home country account without reporting the interest income is carrying a compliance risk they probably did not know they had. The fix is straightforward, but it requires knowing the rule exists. I want to be clear about where I stand on this personally because my position is more complicated than stop sending money home. I have not ruled out retiring in the Philippines. That possibility is real. It is on the table. And because it is on the table, I have deliberately maintained a financial presence there. When the Canadian dollar is strong against the peso, I move money. The conversion works in my favor. That money sits in Philippine high-yield savings accounts that are paying rates Canadian banks stopped offering years ago. 4, 5, 6% on a peso deposit. That is real yield. And if retirement back home does not happen, that money becomes something else. A vacation fund. A family allocation. Money that grew while I was not watching it, without effort, without stress. Available when I arrive, so I'm not converting currency at the airport and not calculating on a phone what I can afford. The best vacation, in my experience, is one where the money was already there. Saved intentionally. Grown quietly. Ready. So I'm not telling you to stop your home country financial strategy. I'm telling you the difference between running it by default and running it by design. What I do is deliberate. I know the CRA reporting requirements. I know the T1135 threshold. I know the transfer fee difference between my bank and a regulated digital provider. I have done the math on what those Philippine accounts earn versus what a TFSA sheltered position earns in Canada, and I have made a conscious decision about how much belongs in each place and why. That is the difference. Not the behavior itself. The intention behind it and the Canadian compliance structure around it. Default is expensive. Design is cheap. 3 moves. Each one is specific to the Canadian system. Each one protects your home country strategy while building your Canadian wealth simultaneously. The first move is what I call the Two-Country Audit. Most people in my audience are running a home country financial strategy and a Canadian financial strategy at the same time without ever having mapped them together. That map does not exist on paper. It exists only in your head, and what exists only in your head has no structure. The Two-Country Audit is a single document. 1 page, 2 columns. The left column is Canada. List every registered account you have, TFSA, RRSP, FHSA, if you have opened one, the current balance and the unused contribution room. Include your employer pension if you have one. Include your credit score. The right column is home country. List every account, every asset, every regular transfer. Include the current local interest rate on each account. Include your average annual transfer amount and the fee you paid last year to send it. Once you have that document, 2 things become visible that were invisible before. First, you can see whether your home country yield is actually beating your Canadian opportunity cost. In some cases it is. Philippine high-yield accounts at 5% may genuinely outperform a Canadian HISA, though not a TFSA sheltered index position. Second, you can see whether you are meeting your CRA reporting obligations. If your foreign assets cross the $100,000 threshold, the T1135 is not optional. The Two-Country Audit takes 1 evening. You should do it before the end of this month. The second move is the Transfer Efficiency Review. If you are sending money home regularly, you are almost certainly overpaying to do it. The major Canadian banks charge between 3 and 6% on international transfers, embedded in exchange rate markups and flat fees. Regulated Canadian digital transfer providers, and I want to be precise here, I mean providers registered with FINTRAC, Canada's financial intelligence regulator, typically charge between 0.5 and 1.5% of the transaction value for the same transfer. On $10,000 sent annually, the difference between a bank transfer and a regulated low-cost provider is between $150 and $450 per year. Over 10 years, that is $1,500 to $4,500 in fees you paid to institutions that added no value to your transfer. Here is the sentence to use when you are setting this up. I'm looking for a FINTRAC-registered international money transfer provider for regular transfers to the Philippines or India or Nigeria or Ghana or wherever applies to you. FINTRAC registration is the compliance test. It confirms the provider is regulated in Canada. Do not use any international transfer service that cannot confirm FINTRAC registration. The Transfer Efficiency Review recovers money you are currently giving away. It does not require you to change how much you send or where you send it. It only requires you to change who you pay to move it. The third move is the Canadian Floor First Rule. This is the structural principle that ties everything together. Before any money moves out of Canada, whether to a home country savings account, a family transfer, a foreign investment, or a vacation fund, your Canadian registered account contributions for the year are fully funded first. Full stop. Your TFSA limit is $7,000 in 2024. Your RRSP limit is based on your prior year earned income, 18% up to a maximum. If you have employer RRSP matching, that matches the highest guaranteed return available to you in Canada. A 50-cent match on the dollar is a 50% return before the investment earns a single percent. Nothing in a Philippine savings account competes with that. The Canadian Floor First rule does not eliminate your home country strategy. It sequences it correctly. Canada is funded first because Canada's registered accounts offer tax advantages and, in many cases, employer contributions that are irreversible if you miss the year. Home country accounts earn yield. Canadian registered accounts earn yield plus tax shelter plus, in many cases, free employer money. The floor is not the ceiling. Once Canada is funded, everything else is yours to allocate as your dual country strategy requires. What this looks like in practice: take your net monthly income. Identify the monthly amount that represents your annual TFSA and RRSP target divided by 12. That amount moves to your Canadian registered accounts first by automatic contribution if possible. What remains after your Canadian obligations, your rent or mortgage, your monthly budget? That is what your home country strategy works with. That sequence sounds simple. It is not natural for most people in my audience because the home country pull, the family obligation, the conversion opportunity, when the dollar is strong, tends to take priority in the moment. The Canadian Floor First rule removes the moment from the decision. The decision is made once in advance by automatic contribution. The moment never gets to override it. Your family's savings habits kept your family intact. In a country where that was the challenge, those habits were exactly right. Canada is a different challenge. The threat here is not a failing bank or a collapsing currency. The threat here is a financial system that rewards participation and quietly penalizes absence. Every year your TFSA sits empty is a year the system taxed you for not showing up. You can run a home country strategy and a Canadian strategy at the same time. Charles does. The condition is that it is designed, not default. The Two-Country Audit, the Transfer Efficiency Review, and the Canadian Floor First rule are the design. Subscribe if this names something you have been carrying but nobody has explained. The next video covers the Canadian account most newcomers have never opened, the first home savings account, the FHSA, and why it is the single most underused financial tool available to multicultural Canadians in Canada right now. You survived a system that failed. Now build inside one that works.